name is Jimmy Hinton. I work for Newmark, and my responsibilities include helping our clients and our shareholders with their investment strategy. Well, the subject matter that's on everybody's mind is the bifurcation between trying to buy high quality assets and trying to take advantage of any distress that's going to come in the market over the next few quarters and years. The way that investors are thinking about that is they're focusing on high quality assets that have proven demand from tenants, where they know that they're going to have cash flow and that cash flow is going to grow. And then conversely, other investors are looking to buy high quality assets that they may be able to buy at a discount to the cost that it would require to build that asset. And those are two very compelling investment opportunities. And sometimes the same investor has both of those strategies. Sometimes investors are more singularly focused on one versus the other. Really, through any investment cycle, what I'm always telling our clients is you want to have a very high level of conviction in your business plan and your underwriting. So with high quality assets, you're going to find that tenants have a much higher probability of not only signing a lease in that building, but staying in the building. And so if you're willing to invest the kind of capital that it takes to purchase an asset with conviction in an environment like the one we've been dealing with for the past year or two, it's been challenging. Proof of demand is paramount in order to pay the prices that are required to transact. On the other side of the coin, a lot of the reason why assets are in distress is not because the previous owner made a mistake, but maybe it's a more challenging environment for tenants to have a desire to occupy the asset, right? So you have to be absolutely positive that the basis that you're achieving when you're buying the asset is such that you can put additional capital into the asset to make it attractive to a new tenant who otherwise wouldn't have a desire to occupy that building or that retail center, that hotel, that office building, et cetera. When we look at the marketplace and the way that people have made returns over the past 2 or 3 cycles, timing is important. And most investors are feeling like right now is an excellent time to buy assets because valuations are generically off somewhere between 10 and 40% depending on the property type. So people are very excited about the timing of making an investment. A lot of return has been generated by capital appreciation the past few cycles. And right now, real estate is not unlike stocks or bonds. People are very focused on cash flow, which is important, right? And so if you are establishing a basis in an asset that has an attractive entry price and that asset's going to be bolstered by really durable cash flow through the hold period, then the cash flow, represents a more conservative contributor to return going forward, and the capital appreciation is upside. Now, what's going to take the capital appreciation higher than underwriting? It's going to be the prevailing cost of capital environment. So we see investors making sure that they're underwriting returns based on today's cost of equity and debt. And as that cost of equity and debt declines, as monetary policy eases and the Fed maybe curtails their interest rate policy, then investors can kind of ride that wave, and we may see a compression in cost of capital. We therefore would see a compression in cap rates, and valuations in a neutral cash flow environment would appreciate, which would be a home run for everybody involved. So one of the things that I think investors tend to overlook sometimes is who they're competing against in terms of fellow landlords and what motivates them to make decisions about their own assets. So if you are an owner of a building and you're not paying very close attention to not only what buildings you're competing against, but the mentality of the owners of that building and what drives them to make decisions about capital improvements or signing a lease, those types of things sometimes are very difficult to underwrite for investment committee. But that type of behavior has been very important in the current environment relative to being able to acquire and retain cash flow in the asset. So one of the nuances that we see with the competitive landlord environment is, sometimes a REIT is more prone to focus on occupancy versus cash flow. And sometimes they're willing to take a lower rent in order to make sure that their building has a higher level of occupancy. Whereas a private capital investor may be focused exclusively on rental rate and hold asking rents higher at the expense of occupancy. And the dynamic that exists between those two decision making criteria can create an environment where you've got something that is affecting your asset that you weren't necessarily underwriting your business model. So, that type of nuance is really important, and it's difficult to put into your Excel model when you're making a buy, sell, hold decision.